Good morning, everyone. It is Friday, February 27th, 2026, the last trading day of February. And it's been a very lively month. We've had, hundreds of earnings announced. We've had big companies announced. More recently, NVIDIA announced on Wednesday. And the market has really moved. It's set up some surprising trades, some momentum to the downside, some momentum to the upside. And we are here to talk about stocks and try to, if anything, just understand fundamentally what's going on with these businesses. And my colleague Daryl is going to look at the charts and try to understand what's going on in the market. Try to establish are these stocks trending higher, lower? What is he seeing in that data? How you doing this morning, Daryl?
Doing very well, Victor. It's good to be here. Thank you. Hello, everyone.
And it was great to do the watch party on NVIDIA with you. Thanks for doing that. And boy, we
Thank
should
you.
talk about NVIDIA because it was a big surprise. NVIDIA announced terrific earnings. I mean, the numbers are like fantastic, and I don't use fantastic as an adjective all that often, but with NVIDIA, they were fantastic. And the stock traded lower. I think the market established a sentiment that, hey, it's great now, but what's going to happen, down the road? And the down the road risk or fear is what drove the stock down. It took the whole space down. So that'd be an interesting stock to look at. We'll look at that one later in the stream. The stocks that we wanted to take a look at: Intuit, which announced yesterday after the market closed. We're going to talk about CRM, which is Salesforce. It announced 2 days ago. It did exactly the opposite of what I thought it was going to do yesterday. More to come on that. We're going to talk about Accenture, the big professional services company. That was a request from Eddie, a member of the channel. And then we're going to look at Netflix because they decided they got cold feet. The wedding was all set. They were going to get married with Warner Brothers, and Netflix decided, you know what? We are out. We're going to allow Paramount to acquire Warner Brothers. It looks like Netflix is going to stay as is. It'd be interesting to revisit that stock because it has been under pressure for 3, 4, 5 months, and the stock price has come down. Is it a good opportunity? Now that we know Netflix is not going to change fundamentally, it's going to be pretty much the same business we've known for a while. So it'd be an interesting one to take a look at. And then we'll look at NVIDIA toward the end of the stream. I'm curious to see if the market's going to be buying NVIDIA stock today or if it's going to be selling. We're about 26 minutes from the market opening. So by the time we hit NVIDIA, we'll see if it's trading higher or lower. So how's that sound, Daryl?
Sounds wonderful. Let's go.
Let's do this. Looks like Ben 10 is with us. Ben 10, good to see you. And I did see that Celsius had a real good earnings, and that's a stock we've been taking a look at. I've had positive sentiment toward that stock because the fundamentals look good. Its growth is better than its industry peers. The stock has gotten a little expensive, but let's take a look. Let's take a look and see what's going on there. Then EVR, I don't know what EVR is, but we'll take a look. That is down the list a little bit, Ben 10, so please be a little patient on those. And Mike is on. He wants to, I hate being a looky-loo when you've got, an accident on the highway. You look over there and you cause more traffic. Everybody does it. Next thing you know, you have a slowdown. And Duolingo, I don't know if it's a 3 or 4 vehicle accident, but it's a doozy of a situation because I glanced at it and it was down 24%. Oh, man. So, it is bad for Duolingo. I think the headline that I saw was, of course, AI. And Duolingo's changing their strategy, which kind of feeds the worries there where, oh, you see, it's real. AI is really, going to disrupt Duolingo. So 18 car accident. That might be more accurate. The Duolingo situation might be an 18 car pileup, where you've had this cold weather and the roads are all iced over. And next thing you know, you got a pile of big rigs and cars. So we'll get to that 18 car pileup a little later. Let me kind of take a glance at where we're at as a stock market. We're supposed to open a little lower. Now, did you get your head around the inflation report that came out this morning? What was your read on that economic data?
Yeah, it came in pretty hot this morning, so that's a bit concerning. That's what's driving the markets overall down this morning.
And the Federal Reserve, I forgot what their titles are. There's a chairman, and then there's
Governors.
governor. That's the right word. So several of them have been careful, not necessarily hawkish, like, oh, inflation's this big giant problem, but they weren't dovish, like, hey, we should just lower interest rates and just make this economy kind of go faster. And now I'm thinking, boy, those governors really knew what they were talking about. Because when you have an inflation report like the one we're seeing, we don't want inflation to go up again, right? Because it really hurts the average consumer, and we don't want, food prices to go any higher. We don't want everything to go up higher. Having said that, it's one report. Let's keep our fingers crossed that next month the inflation comes down. We don't have, nasty inflation again. But it is a concern that, well, there's two things. First, the governors were, I think, wise to not lower interest rates. That, automatically, like, okay, let's just lower them now, because now they have something to work with. They can slow down. They could keep interest rates where they're at so they don't make the problem worse. I would expect that maybe it's going to be middle of the year before we see any rate reductions. And that's going to affect stocks because of the discount rate.
Right.
Yeah. So that's going on. Crude oil.
Mortgage rates drop below 6. That's kind of a psychological level. So we'll have to get in anyway.
Hey, Daryl, I think that internet, I think you've got a gremlin in that internet, because it's
Okay.
really slowing your speech, and it's done
Let
it
me
3 times.
Let me restart.
Go for it. Go for it.
Okay.
I'll wait for you to get back before we get into some stocks.
Okay.
All right. So crude oil is higher 3.8%. So that's going to move energy stocks for sure. And when we look at the heat map, boy, this heat map, the especially the last 2 weeks, I've seen some pretty big changes, big rotations. Yesterday being an interesting rotation of investors moving out of semiconductor and, of all places, moving into software. And they also moved into financials. Netflix picked up a bid. The news now that they're not going to acquire Warner Brothers. And I count that as a positive for Netflix. I didn't like that they were going to acquire what I felt was a lot of legacy businesses, or a big legacy business. I think they should just lean into the future. Like, hey, you're a streamer, and FYI, Netflix started when DVDs used to be rented. I was a Netflix customer way back when their complete business was you would go online, you would rent DVDs instead of going down to Blockbuster. They would mail you the DVDs. You'd watch them. They'd give you these return envelopes. You put them in the mailbox. They go back to Netflix. and you would have like, I forgot if it was 3 or 4. You could have 3 or 4 videos in your possession at one time. So they started in the previous paradigm, and then they saw that streaming was gonna be everything in the future, and they went all in on streaming. Good for them. Well, keep doing that. Don't let go of that culture. Look at the future, grab the future, and make your company what it should be for the next 10, 20 years. And I think, if anything, this Warner Brothers deal not happening is a good thing for Netflix, because Warner Brothers has been around for 100 years, and that's not an exaggeration. It's been a studio, it's been around for 100 years, and it doesn't have a strong grasp on the future. It's actually been run over by technology and advancements in how we consume movies, shows. I mean, Warner Brothers was built on people go to the theater and watch a movie. Well, that's pretty much a thing of the past for the most part. They built businesses around linear TV where they built, most of their programs. Let's talk about Bugs Bunny, right? I watched Bugs Bunny when I was a kid. That was linear TV. You would turn a dial. We thought it was really cool when you got a remote in your hand. And so I think it's good news for Netflix, and we'll get into the fundamentals in a little bit. I think it's been interesting that financials have been catching a bid, and I've been keeping an eye on Visa. Not quite sure why Visa sold off recently, but the pricing on Visa is pretty good. It is a very, very good business. Some other stocks, the one that really flew up was Coinbase, because they are selling stocks on their platform now. That went there. I'm a Coinbase investor, been in Coinbase investor for a couple of years, and yep, they're selling stocks there. Their stock went up um, uh, on Wednesday. Yeah, it went up on Wednesday, and then it about 15%, and then gave up some of that gain, and gave up about 5% yesterday. So we'll see where it goes today. So it's been a really interesting market. If we look at the year to date, it's always good to see. Okay, let's look at a couple months. Software has just been a bloodbath here. Just been getting sold off. The market thinks software stocks are going to be disrupted by AI. I'm not quite convinced. I'm not nearly convinced, especially around some of these really quality businesses. I think these quality businesses are here to stay, and they've dealt with new technology paradigms before. You think about Intuit. We're going to talk about Intuit in a little bit, so I'm going to give you a preview. Intuit's been around for more than 40 years. 40. When they started their software company, it was what we referred to as individual licenses or client server. Individual licenses, when you bought TurboTax, you bought it at Costco, you bought it at a retailer, you took home your DVD, you loaded it on your computer, you did your taxes. And the same thing for their QuickBooks software. So the internet came out. Now, you would think, well, that might kill Intuit. No, made them stronger. They made them, the ability to distribute their software became more efficient. So they actually became stronger, more profitable. All right. So then software as a service came out. Well, Intuit again, they started way back when. They used to do what we refer to as perpetual licensing. Perpetual licensing means you buy the right to use that program, and you buy it once. And if on the enterprise level, you could pay support and get updates and support on it. But with Intuit, it's predominantly a consumer-based software. So when software as a service came out, again, new paradigm. Is that going to kill Intuit? Didn't, made them stronger. So these guys keep getting stronger because they have this real big customer base. And that customer base, they don't want to go somewhere else. Like when it comes to taxes, yours truly been using TurboTax. Geez, for how many years? I'm going to say I've been using it for about 34 to 35 years because it's not compelling. Like, of course, there's other companies that want my business, but they have my data. I know what I'm doing with TurboTax. I get it done. My taxes are complicated. And yeah, maybe some other vendor might save me $200, but at what risk? And is that going to cost me, 2, 4, 6, 8 hours more? I don't want to do that. I'd rather just, all right, TurboTax. You get my fee, I do my taxes, and I move on. So when we talk about software, I think it's overdone, but the market's going to do what it's going to do. It's going to run with a theory until that theory gets proven wrong. And if it gets proven right, then hey, everybody who followed that theory is like, see, told you. Now, if it gets proven wrong, it's a great opportunity because these businesses are highly profitable. They continue to grow. Intuit put up good growth numbers. So did CRM. And they just make more money, but you get to buy the stock at a lower price. That's great. That's like going to the discount store and saying, whoa, here's a pair of Nikes that a couple of years ago I was paying $200 for, and now they're $50. I'm going to buy a pair. I'm out the door with a new pair of Nikes. So we'll talk about software. We're going to talk about Intuit and CRM. Amazon's been under pressure this year, and that's been an interesting situation. I don't know why the market's selling off Amazon. I've said that before, and I am not going to say it again so much on this stream. I'll give you guys a day off of talking about Amazon. All right, looks like Ricardo's on. He wants to talk about FCX. Man, you guys showed up today. You guys want to talk stocks, which is great. It looks like Daryl is back. Good to have you back, sir.
Thank you.
And we've got Ben 10. SoFi's getting blasted. We've got multiple accidents out there, multiple multi-car collisions that we're going to have to take a look at. Take a look at SoFi, see what's going on out there with SoFi. We'll take a glance at it. Okay, so let's get the wheels moving. Let's talk a little Netflix because I just think it's super interesting to see these soap opera acquisitions. And it's interesting to see because when I heard, and look at that, the market likes the fact that Netflix is walking away. When Netflix announced we're going to acquire Warner Brothers, I'm not a current Netflix stockholder. I bought the stock. I made a very good return. I sold the stock. And the long and the short of it is, I just thought it was strategically a bad idea. You're grabbing the past when you buy Warner Brothers, and you're bringing a bunch of legacy business practices, models, culture into what is a fairly dynamic growth culture over at Netflix. Just keep being Netflix. Just get bigger and keep doing your thing. So the acquisition being terminated, not a bad idea. Not a bad idea at all. And when we look at where the price has been over the last couple months, it's been under pressure. It's picking up a nice little bid now, but ever since June, from June until now, has not been a good situation for Netflix. And this puppy discounted. We know what they do. You guys are all probably Netflix customers. You're giving them, I don't even know how much we pay them. I've been paying them forever. And I'm not going to turn it off because, hey, you know what's coming out today, Daryl?
What's that?
Drive to Survive. You know what I'm talking about?
I've
F1.
What is that?
F1 automobile racing on Netflix. I was never an F1 guy. And then Netflix took that and they take a whole season of F1. They put it into a show. It's really compelling. And I really like when they put that together for me. That's one of the reasons why I just don't cut my subscription with Netflix. Plus, my wife and I like spending time together watching Netflix. So I'm not going to cut it off for multiple reasons. So these guys are growing. They're already big, $45 billion, growing at 15%. They have good profitability. Let's take a look at that forecast. Now, I wonder what analysts are thinking. How do you forecast a business that may acquire Warner Brothers? Hopefully, they just stayed steady with, okay, we're only going to work on what we know is going to stay. And it looks like this year they're going to keep growing 15.4. And as you get bigger, it gets harder to grow at the same rate, right? It's just the mathematics of it all. But these are really good growth numbers. And the profitability, look at this expansion of profitability. Double digit, very nice profitability expansion. Netflix at 16 PE. I'd like to buy Netflix at 16 PE. If anybody would like to sell it to me at a 16 PE, I would gladly buy it, take it off their hands. But looking a year ahead, 21.7, that's looking pretty darn attractive. Let me flip it over to Daryl to see the charts. I'm going to come back with a valuation on Netflix, and we can keep talking about this streaming giant.
Yeah, I think this is a really good opportunity for investors. So the Warner Brothers deal was detracting, I think, from Netflix a little bit. I think they would have done okay with the studio. It would have given them a nice opportunity to own some pretty reasonable assets, but there was going to be some impact to their business as far as investors were concerned. So they really did have a sell off. But now that this deal is off, I think Netflix is going to get about $7 billion in cash. That'll go straight to their.
So hold on a second. They're going to get some cash out of this?
Absolutely. Because Warner Brothers is terminating the agreement and there's an exit price. So Netflix will pick up about $7 billion.
Oh my gosh. Well, then Netflix is a lot smarter than I thought. I already thought they were pretty smart, but boy, they're a lot smarter than I thought.
Yeah, nearly every merger has that.
I just didn't know that. I guess you're right, because whoever cancels it is liable to the other party. In this case here, Warner Brothers is like, hey, you know what? We got a better deal over here, so we're going to cancel it. And Netflix is, all right, you got to pay me some money.
Yep. And Paramount agreed to pay that termination fee. So that's going to go straight to their debt.
Oh, man.
So I don't see this ending well for Paramount, but we'll see. So this is a great opportunity. If you've been waiting to get into Netflix, they're going to be up today. I don't know what you showed it earlier. They're going to be up to open up around $92 a share.
Yeah.
That's still going to be just above the 50-day moving average.
Mm-hmm.
And if they close above that, then to me, it's kind of a no-brainer. If you want to own this one, you ought to take advantage of it today, even at the higher price. So we had a support line that went all the way back to November of 2024. It was tested in January, tested in April. They broke down below it for looks like 2 or 3 weeks. And 2 days ago, they closed above that support line. And then yesterday, they further solidified that. We had good volume on both of those days. The RSI is back above 50. We have a buy signal on the PPO. It is still in bearish territory, and I see positive accumulation over the last week. And the money flow is negative. It's moving back towards a neutral zone. So if you really wanted to be safe, you'd wait, until we had some stronger signals here. But if you're an early adopter, I don't think you want to miss this. If Netflix is on your buy list, today's the day.
And, I'm going to show you my valuation. This is an app I just created. It is really discounted. Netflix is, and it's discounted on both discounted free cash flows and your earnings per share. So if you blend the two, the cash flow is going to be far better because you're not going to have Warner Brothers. Warner Brothers, its profitability just is different than Netflix. It was really going to change the company. I didn't want anything to do with Netflix if they're going to acquire Warner Brothers. But now it's like, whoa, okay. If you're not going to acquire Warner Brothers, then it's a whole different recipe for success. So it's a nicely discounted stock. It is going to be hard to buy it today because it's really moving higher, but it definitely should be a consideration. I am so invested in communication services. I gotta pump the brakes because as you guys know, I'm big into Google Alphabet. Google Alphabet has YouTube. If you said you can own one or the other, you can't own both. Would you like to own the YouTube business? Or would you like to own Netflix business? 10 times out of 10, I would say YouTube because it's just a better business. You don't have to pay for content. It's growing faster. It's bigger. Every metric is YouTube is a better business. And of course, Google Alphabet owns YouTube. So that's where we're at with Netflix. If you have been interested in Netflix, it's good news for investors. The company's going to stay as is. It's up 10% now. Good for them. It's a pretty good size cap too. 357 billion. So 10%, that means that probably about $36 billion of inflows are coming into this stock, making it go nice, bright green. So Netflix is going to have a good day. All right. So which one do you want to go with, Daryl? Intuit or CRM first?
It doesn't matter, whichever one you want to cover first.
All right, let's go over CRM because that one's been out for 2 days because this is it's a mystery that I haven't been able to solve. So we had earnings on Wednesday and the after hours action on Wednesday wasn't good. It was like, okay, market didn't like the earnings so much and the stock went lower by like 5-6% in after hours. And then we had our trading session and it went up 4%. So I was scratching my head going, okay, it did exactly the opposite of what I expected. So I'm like, okay, I guess investors had been, because if you look at the stock, right, this has been sold off along with a lot of the software stocks. The software industry is under a lot of pressure because there's a theory that, hey, AI is going to take away revenues. It's going to make these companies less desirable. And it's a theory. CRM, Salesforce continues to grow its revenue. In the quarter, it grew by 12%. For the year, it grew by 9.5%. It's a pretty big outfit, 41 billion. So it's not like, oh man, they're barely growing. Well, they're growing by more than $4 billion in top line revenue. That's pretty darn good. But are they profitable? Well, let's take a look. Well, gross margins is 78%. Yeah, the answer is absolutely. And profit margins are there. Free cash flow is fantastic at 34.6. So you have a business that drives very good profit, very good cash flow. It has a decent growth rate, and they're going to start buying back shares. But the buyback program, it's let's put that off to the side because that's not important to me. What's most important to me is this top line. And if they can grow, they're going to end this or make this theory that AI is going to hurt them, make it false or make the conclusion false that, hey, no, it's actually going to be good for us. Salesforce, just a quick little history lesson on these guys. So when Salesforce was born, it was in the late 90s. And back in the day, they sell what we call enterprise software. That's software used by big businesses. And they have Salesforce running for, let's say, a company, and they have 20,000 people logging into the same enterprise application, working with customer information, product information, all kinds of stuff. And when the internet came out, Salesforce was a pure play internet company. They were one of the first software as a service companies. They were a disruptor, and they pretty much took a lot of market share away from the leaders at that time, which was Siebel Systems, as well as a bunch of other CRM companies. And Salesforce became the dominant player. And they were just this little rinky-dink little company in the late 90s, and now they're gigantic. So Salesforce knows technology. They also know what paradigms look like because they took advantage of a big one. And I think the AI front, they've been working on AI for, I'm not kidding you, more than 10 years. Their product was called Einstein. It never took hold. Maybe it wasn't good enough, kind of like Siri on Apple and Alexa on Amazon. That's AI. Those are agents that are on your device, and you're supposed to be able to ask them questions and they give you the right information. The problem was the information was shallow, wasn't good enough. So those systems came and went without it getting a lot of adoption. But now AI is the real deal. Let me tell you, I've been using it. I'm very impressed. Now, I think Salesforce is going to take AI and make it very impressive. I know the culture at Salesforce. I know the company, and I think they're going to make it through this a winner. That's one investor. That's me. The investing community is not sure. They're like, well, we think it's probably going to be hurt by AI. And that's why the stock is really sold off. Now, Salesforce is discounted. I'm going to show you my valuation, but last time I showed it to you, it's highly discounted. It will remain discounted. Forward P of 14.5. Again, this company has high 70 gross profit margins. You go to industrials, and some industrials are rallying higher with 30% gross margins. It's like very little money in their business, very little money in their industry to be made. And here you have a software company that makes lots of money and is being thrown away with last week's garbage, which to me, if Salesforce can prove we're not going anywhere, we're actually going to get bigger. We actually have new products that are AI based, and we're making more money now. This is going to be a giant opportunity. But right now, it could be an opportunity wrapped in just a lot of negativity, a lot of fear, and it's not going to rally higher until the theory gets proven wrong, and investors are like, oh, we're going to buy Salesforce because it's a great business, and the theory was incorrect. So I'm going to wait on my valuation until after Darrow shows the charts, but let's just take a peek at what analysts are saying. 37 of them think it's highly discounted. Everybody thinks it's discounted. We're just waiting to see, is AI going to kill Salesforce? Right? I'm going to go back 50 years. Remember that show, Dallas? Who Shot JR? Super compelling television. And is Salesforce going to be killed by AI? I don't know, but let me turn it over to Darrow to see if he can answer that question.
So we're looking at 3 years of data here. I have a couple of auto support resistance lines set. They have broken below this top one, and this one could be in play just above 160. The reason I wanted to mention this one today, we also see they've been on a downtrend, a confirmed downtrend. So even the 200-day is heading lower at the moment. The reason I wanted to mention this one is I saw a lot of exuberance in some chat rooms yesterday about CRM because it was higher yesterday, but I really noticed something in the volume and the price action yesterday. So look at the volume. The volume is that was yesterday's volume. So this was about 2.5 times the daily volume, and the price was higher. But notice that the candle, how small that candle is. What that told me, and I actually, put out an alert to users. Be careful here if you're buying, because when you see a small candle like this, that means that there are institutional holders that are selling there. So retail is buying in, they're driving the price higher, but the reason that the candle is so small is institutional investors are providing a steady stream of supply throughout the entire day to retail investors. That's why you have the large volume, small price bar. My warning is be careful because it could go down. It is down today, 4.23%. Yesterday, it made it above a 21-day moving average. It would not be a buy for me until it sustained several days of trading above that 21. But this was a warning signal yesterday that there were institutional sellers. So whenever you see a small price bar on big volume, a lot of effort went into buying and selling. Price action was very muted. That means that there is some absorption going on during the daily trading. So I hope, unless you are a super long investor and believe in this long term, that you weren't buying yesterday, because this is exactly what I expected to happen and put out a warning on it. We'll see what happens today and over the coming week. I still think the 160 price is in play on this one. We
Good
have
call.
a 200, pardon me?
Good call.
We see a 200-day that's declining, a 50 days declining, the 21-day tried to level off yesterday. It's going to be down again probably today unless they can recover throughout the day. Early trading tells me it's not going to recover. We got a red bar with a lower tail, so I don't expect the price to recover at all today. We did not get back to a 50 line on the RSI, and it's pulling back to 40. We did get a buy signal a couple of days ago. I think that was pretty much a head fake. So I think 160 is still in play.
Okay. So the market is it's like if you want to get your barbecue charcoal briquettes nice and red, that's what it looks like. We've got it nice and red. Nvidia is still under pressure. The CRM and other software stocks are under pressure. So we got some stocks that are really feeling it. Back to my valuation on CRM. CRM is highly discounted, and if you measure a company's free cash flows, and the way I invest is I look at the big picture. Qualitatively, I need to be bought into the business. Do I believe the business is going to be better in 5 years? And the answer on CRM is yes. I think they are going to be better in 5 years. And it is a stock that's right at the center of my circle of competence. This has been the industry that I've worked in. I know this industry. I know some of the dynamics. I know how strong their moat is, their customer base. It's very hard to move off CRM software. Okay. A company's like, hey, let's move our 30,000 users off of Salesforce. Yeah. Good luck with that. That's going to be like a 5-year endeavor to do it right. So companies are like, yeah, there's no ROI in doing that. I mean, what are you going to move to? Oh, we're going to move to that you're working with the leading company. So there really is no alternative other than stay on Salesforce. So having said that, it's a really interesting opportunity. We'll put this in the time capsule for 2026, February 2026. But I think if we go 3 years down the road, like we've seen with Netflix, like we've seen with Meta, Google, I could go down the list of all these stocks that in the moment it was like, wow, there's some stories out there. Let's talk about Netflix again, because Netflix was a fantastic opportunity that I think the same could happen for Salesforce. A couple of years ago, right? You know, Netflix was deemed to be just a bag of hammers. Just like, man, not good. Down 74%. Market's like, yeah, Netflix, who would want that company? Terrible business. I bought the company. I bought the business and I accelerated my buying. And look at that, 653% rate of appreciation over a 3-year span. That's what happens. That's what happens when a theory, a story, the market's like, oh man, Netflix is terrible. I could show you multiple examples. Is CRM going to be a similar situation 3 years down the road? I think will be. But we gotta play out the next 3 years. So that's where I'm at with Salesforce. Right now, the stock is under pressure. Under pressure. Jeez. I've been so amazed by the sell-off in software. I've been amazed by it. I've been amazed by the run in semiconductor. Never seen it. It's like, whoa. Never seen Sasquatch, but now I believe in Bigfoot. It's like, oh my gosh. But here we are. Salesforce has sold off. All right, so let's move on to Intuit. We could probably bang that out real quick. So Intuit's up a little bit. That is interesting. The numbers were really good from their earnings. Solid earnings. And Intuit has been around for more than 40 years. Their customer base is huge. It's like a little bit like Meta in the fact that they have millions of customers, like hundreds of millions. And when you look at this stock and you look at their growth rate, they're a pretty good size outfit. 17.3% rate of appreciation on the top line. This is not smelling, looking like they're being disrupted by AI. And our friends over at Intuit, have they dealt with adversity in the past? Absolutely. They were started 40 years ago, was individual licenses. You would buy them. I remember buying my license at Costco. You'd get it in a shrink wrapped, package. You take your DVD home and pop it into your computer, do your taxes. And I was never a QuickBooks customer, but it was a similar scenario where you would buy it and you would take it home and install it on your computer and you would do your books on QuickBooks. Then the internet came around and they adopted the internet and they did really well with the internet, lowered their distribution costs. And software as a service came out. Intuit, you're going to be in trouble. No, they adopted and made that an opportunity and boom, they are where they are now. And this has been a total success story. Okay. So if this top line revenue continues to grow, same thing with CRM, these guys are going to prove the theory wrong that, hey, AI is going to kill us. No, I think right now nobody could clearly express, here's how AI is going to kill Intuit, because there's this product out here that's going to be completely replace, Intuit, QuickBooks, TurboTax, and so forth. So we're going to have to play it out. Right now, Intuit is discounted. It's interesting that it's kind of holding its stock price. Look at that. The 5-day looks pretty decent, but the 1 year looks terrible. So I've been buying it. I bought into Intuit because I've followed Intuit for the last 20 years as a stock. And I could tell you Intuit would always get a very favorable valuation, meaning there was very little discounting on the Intuit stock. And I just waited. And then all of a sudden it started to get sold off. And I'm like, man, here's an opportunity for me to buy into it. I've always wanted to buy into it because qualitatively, I think it's a fantastic business. Their moat is their network power. You have millions of people using TurboTax, millions of people using QuickBooks and, small businesses. And when you have that type of network power, it's very hard to change over. People don't want to change over. And if given a choice, you want to stay the same, not put any effort into moving and migrating, and you get the same benefit as what everybody else is claiming, you're going to stay put. And I think they have an opportunity actually to use their customer base and provide an AI product and charge them for it. Beautiful. And expand their revenues. So I'm in it with Intuit. I think they have a terrific business, and I'm going to continue to be an owner. My software stocks, I'm not selling them. Look at that, 88% discount on Intuit. 88. These are 19 analysts. Now, these guys, I don't follow analyst guidance, verbatim and just go buy stocks based on it. But these are educated voices. They do have some input, or I should say, I do pay attention to them, but I do my own valuations, as you guys know. Forecast looks good. Double-digit growth. Double-digit expansion of profit. PE ratio going to single digits in 4 years. Incredible. I think it's an opportunity. I think 3 years from now, we're going to look at these stocks and say, wow, remember back in 26, we could have bought Intuit at a much lower price. We'll see how that plays out. Let me flip it over to Daryl to take a look at the charts on Intuit.
Yeah, so on those analyst recommendations, I look at them as well, but keep in mind that those are sell-side analysts, and they get paid for putting out recommendations. So what you really need to do is take their recommendations and give it about a 20 to 30% haircut to make it more reasonable. And then, like Victor said, do your own valuation, because that'll give you, your best assumption, and you compare it to those investors. Just keep in mind they get paid to do that. So Intuit. I shared an Intuit chart yesterday as well, because I went out and looked at several software stocks after I saw them jumping up yesterday, and saw so many people talking positively about them at the moment. I just wanted to caution everyone what I was seeing. This one basically had the same situation as CRM. It's not down today. They were down in the pre-market, but they're also not trading above a 21-day moving average yet, which is where I would get back interested in moving into a stock like this. I don't own this one. I don't own CRM, just so you're aware. But if I were, that's where I would get reinterested. So they have an RSI that's below 40. We did get a buy signal. But this volume, look at this volume. It was 3x yesterday.
Wow.
Very little price movement. So institutional sellers had lots of supply right here that they were selling to retail investors yesterday. My belief, my assumption based on what I'm seeing here is that over the next week, we will probably see it lower. So I hope I'm wrong. For anybody that owns it, I hope I'm wrong, but I'm just telling you what I'm seeing in the charts. I have a little visual here that might be helpful. So when you have heavy volume and wide prices, that's kind of a healthy trading day. But what we're seeing with CRM and with Intuit, we're seeing very high volume with very compressed pricing. That's what you put into the absorption column. So there are institutional sellers, they're just absorbing that price, and they're keeping the price steady by just slowly feeding out shares to retail investors. So that's two ways to look at volume and price action. So I just wanted to look at this one as well because it was following a very similar pattern. It is performing a little bit better today than it looked like it was in the pre-market. But the caution here is it's still trading below its 21-day moving average. It needs to get above that and sustain above that 21-day to really be a buy signal.
Nicely done, sir. So let's talk about Accenture. Accenture is a big professional services company. Predominantly, they really built the business around helping businesses take technology and put it into their businesses, use technology. Because really, when you look at the last 40 years, I would say 40 years ago, you did have companies using software, but man, now we use so much technology. We have browsers. Like every day I spend hours behind my computer and I use, I don't know, 10 different software programs. And these guys here have helped businesses use software, do consulting for businesses, help them take on kind of fix problems that they have with their companies. Now, these guys here, in my opinion, are right in the path of being disrupted by AI. This is like the theory that AI is going to hurt Accenture. I do agree with that theory because Accenture makes their money when a company says, "Hey, I would like to implement XYZ technology to help this particular business, uh, this area of my business." Well, the task or the project of getting that new technology has gotten far easier with AI. So if Accenture gets cannibalized by that, meaning we used to charge $100,000 or $1 million to for such a project, and today AI makes that a $25,000 project. Where did that 900 and some odd $1,000 of revenue go? It got vaporized. It doesn't exist anymore. So you have a contracting market of professional services that I think Accenture is going to deal with. It's going to be ugly, in my opinion. High level, qualitatively, I think there are some businesses that I think AI is going to hurt substantially. And maybe short term, Accenture is going to hold their own because businesses are eager to get AI implemented into their businesses. But there's a lot of services that Accenture used to do. Accenture runs managed services, which is basically a company says, "Hey, we've got tech support. We used to have 2,000 people doing tech support, but today we just turned it over to Accenture." Well, with AI, you don't need all that much tech support anymore. You have AI agents doing a lot of the tech support. So you used to pay Accenture, I don't know, $100 million a year. Maybe now you only pay them 20 because with AI, you can make that far easier. You have computers doing the work that used to be done by people. So there's just a lot of pieces there where I would say Accenture is like, I will not touch it. It's right in the path of where AI is going to add a lot of value by taking away a lot of cost, taking away a lot of like what AI does great is it fills in knowledge. Like if you want to know something about a topic, especially around coding, software, technical, you've got you've got a supercomputer with a super brain in AI at your disposal. Go to Gemini, OpenAI, and you have this fundamentally superior path of operating. So these guys, let's take a look at the forecast. And again, the comment that Daryl made, I will co-sign and say that these analysts, it's interesting to see where they're at, but I've never followed analysts, verbatim because I know that there's Not necessarily a conflict of interest, but man, if it was that easy, those analysts ought to be, making $1 billion a year. And these guys here, you see their growth rate is pretty manageable, or I should say limited, single digit. Their profitability staying about consistent. I would not be surprised 3 years from now, these guys are getting disrupted. So that's the qualitative assessment of Accenture, and it starts there for me. If it's in an industry where I really know, which is the case here, qualitatively, do I believe these guys are going to be stronger or weaker in 5 years? I think Accenture is going to have some big threats approaching their business. And the whole threat that AI is going to lower moats and take away business, it does exist here, in my opinion. Let me kick it over to Daryl, see what he thinks about Accenture.
So I'm going to start off with a 10-year view here because I want you to see where I put this auto support resistance line. It was the high in 2020, the lows in early 2021, the low in 2022, and in 2023, and in 2025. So it seems to be a pretty good location where Accenture finds some support. Then I want to go to 2 years because they started on a downtrend on the 5th of February in 2025. They hit that level there, and they just traded right at that downtrend line, moved back above it, and we're trading right at that downtrend line that's been in place for just about a year now. So February the 5th, a little over a year. So now let's step into just 1 year. I'm going to save this. So they are trading right at that trend level. The 200-day confirmed the downtrend. I noted it back in February. It was confirmed in June, and the 200-day began declining. So we do have a confirmed downtrend. The 50-day is below that. The 21-day is below that. So all the moving averages are in the wrong order. Now, yesterday we had a good volume day. It was about 2x, a little over 2x, but we had good price action. So unlike CRM and Intuit that we looked at earlier, it doesn't necessarily look that institutional sellers were actively, getting rid of shares. But today they are down. They have an RSI of 32. They were in oversold condition. We've been on a sell signal basically since the 27th of January. We've been on a distribution until just the last couple days. We see a bit of accumulation, and money flow is currently neutral. So for me to get interested in this, the 21-day would have to be, they'd have to close above that 21-day, sustainably for 2 or 3 days before I could get interested in Accenture.
All right. So kicking it over to me, here's my evaluation on Accenture. And it is just overpriced. And more importantly, and I do really believe that the very first step of deciding to invest in a business, okay, I'm not talking about a stock, I'm talking about a business, is trying to understand how desirable are they. And let me scorecard Accenture here. I'm going to remove these examples for the minute. So Accenture is professional services, and it's a lot like construction, right? Like you have construction businesses have been around for a long time, and they don't you don't hear of construction businesses being worth a lot of money because they have project work and then that project work goes away. The businesses that continue to go up in value are those that just are compounding their revenue and their profits, and they continue to just get bigger and more profitable. And when it comes to Accenture, okay, competition, I think they're pretty good there. They're pretty good with network power. Balance sheet's okay, but the growth is not okay. Profitability is, I would say, okay. And then free cash flow is okay because it's just not very profitable. It's not like Intuit that has very high gross margins, profit margins. So it's in the gray. So whenever I invest in a gray company, it has to be highly discounted. And I could see that the stock's going to produce a good rebound in the future. I would actually think that Accenture and other businesses like them may end up in the red, which is they're going to have contracting business models and businesses overall. I mean, AI in a lot of respects, like going back to like pieces of technology, everybody's got a phone now, right? And if you want navigation, easy, put in an address, you go on Google Maps or Apple, and voila, you got either if you're walking or driving, you got navigation. If you're in a big city, it tells you which subway to get on and so forth. We take that for granted today. Let's go back in the time machine and go back about, let's say, 30 years ago. Let's call it 25. 25 years ago, if you wanted turn-by-turn navigation, you would go to Best Buy or Costco and you would buy a Garmin or you would buy a Magellan device, and it would give you turn-by-turn directions. You'd pay about $300 and voila, you got it. You remember those days, Daryl?
I still have one in my car, actually.
There we go. Do you have an 8-track cassette player?
No, but the reason I do that is I live in a very rural area, so we don't always get a cell signal.
Okay.
So it's important to have satellites in place.
Perfect. So you have a $300 device 25 years ago. Today, pretty much included with your phone. So the price went drastically down and the quality went up. Why? Because with Google Maps, if you're in the city as opposed to the rural areas, not only can I search for maps, I could get restaurant recommendations and look at their ratings. I can look at businesses, gas stations, and all that good stuff. So with the invention of, or I should say the improvement, and really we got on the cloud and we started getting these businesses put out these really awesome cloud features and applications. So Google Maps and its big partner or big infrastructure competitors pretty much put Garmin and Magellan way back in their place. Like Garmin is not selling what they used to sell 25 years ago. Neither was Magellan is a lesser known company. I personally did business with Magellan 21 years ago, and it was a thriving business at that time. They're gone. You can't find a Magellan consumer-based product. Back to Accenture. That's what I think is going to happen. When you have free and lower cost alternatives to what customers have been buying from you for a long time, boy, it's going to be really hard. It's going to be really, really hard. And these guys are right in the path of disruption for AI. All right, moving along. Let's take a chill pill and talk about a beverage company. And these guys, boy, they had a really good week. Yeah, that's 23% over the 5 days, pretty good week. They had good earnings. These guys have been growing better than their competitors. They're still relatively small, 14 billion. You look at where their stock's been, boy, look at that. Look at that. They really grew fast, and then their probably the biggest competitor in the space of energy drinks, Monster, kind of tried to do a chess move on them, and they took a lot of their distribution away because Monster created some partnership with some of their biggest distribution, and that really caused the stock to sell off. But they really rebounded. They were like, hey, you know what? We could take a solid punch. Yeah, Monster knocked us down in the ring, but we got ourselves up, and we are going to continue to fight. And the stock has doubled over the 1 year. Good for them. Good to see that. That's what capitalism is all about. They're up 85% in revenue, but you see where this is where they had that problem with Monster taking a good part of their business. And let's look at the quarterly. I think that'll give us, see, this is where the stock was really hurting. The key was to identify that these guys are going to start growing. And we did cover this stock over the last 4 to 6 months. I did point to the fact that, hey, if these guys can keep growing, this stock's going to keep working because growth in this industry is not that common. And these guys are growing. So there they are. Good for them. I'm not a big beverage investor, so I did not get in the game on this one. And when we look at the forecast, a lot of the growth is behind us, but this year should still be good. Should still be a nice growing year, especially in beverage, right? These guys are happy to grow 4 to 6% per year, and these guys are just cranking up the growth. They're still relatively small, but the growth is really, really impressive, and their profits are going to come back. So the future looks pretty good. Now, it is a stock that probably seen most of its gains already priced in, but whoever got into this stock, congratulations. It was an opportunity right there, knocking on our doors. It was actually pounding on the door. I'm an opportunity. Let me in. And those who answered the door doubled their money over a 1 year timeline. Phenomenal. Over to you, sir.
So this has been a little strange. We had a cup with a potential handle forming here. It really kind of broke down and it's turned into more of a ladle. And I don't have any price predictions on a ladle, but what I would have been looking at, had it formed a cup with handle and then fired, I would have been looking at the price of the right rim of the cup, subtract the low of the base, and add that to the price at the rim, and that would have given me a price target. So I have this one labeled cup with handle, but the handle really never formed. So that really invalidates this particular pattern, and I would not trust it. But they are trading above an upward sloping 200. The 50-day is below that. The 21-day looks to be crossing above the 50 today, so that's somewhat of a positive signal. We had really high volume yesterday with good price action. The RSI is above 60. We have a buy signal on the PPO. My only concern here is these are both black candles. So that means it opened above yesterday's close, but it closed below the open on the same day. That's what a black candle is. So I can tell you that it shot up early in the day and then sold off throughout the day slowly. If we look at it intraday, see what I mean? I can tell by just looking at the candle that this was the price action without actually having to go to this chart. I'm doing that for everyone else's benefit. This one just turned into a red candle, so it's still lower than yesterday. All right, so I don't know what else to say about this one. It looks like there's a little bit of enthusiasm, but I don't know if it's necessarily sustainable. We'll have to see. It's going to close above the 21-day today, above the 5-day, and the 50-day is moving higher. So it looks positive. I'm a little worried about the candles.
It's it's a stock that is priced a little too high for me. And again, I stay in my lane, like beverage. Should I be invested in beverage? Probably not. Why? Because they don't make a lot of money. And what do I know about energy drinks? I don't drink them. Right. So there's just a lot of things that is this in this like in the circle of knowledge that I have of competence? Not really. I mean, I'm not a Coca-Cola drinker. I don't drink Pepsi. I drink water. I'm like in this category, I'm like, okay, I'm not a consumer. Second, have I done business with companies that are bottlers of this stuff? Yeah. Yeah. I've actually done business with some companies that bottle beverages, and I understand what it costs, the capital intensive structure of these industries. You have to buy big machines, expensive machines, and you make money, but you make it like cents at a time. Well, that's not overly attractive to me. I'd rather wear like, I think I was updating a Meta video, converting a short. Something that's never lost on me is Meta makes $16 per person, okay, in revenue that uses Meta. And you know how many beverages they serve their customers? Zero. You know how many things they have to deliver their customers? Zero. They just provide a platform, and they're making $16 in revenue off of each person that uses Meta, Instagram, WhatsApp. Their margins are above 80%. Their profitability is insane. Free cash flows are incredible. That's the business I want to own. So Celsius is not in my lane. And to add to that, you have negative cash flow. So we can't get a cash value. The earnings are pretty much in the dumpster right now, but they're going to get better. So it's just outside of my lane. I shouldn't leave my lane. The stock did look good from a qualitative perspective, as I noted and discussed over the last 4 to 6 months. Congratulations to those that own it. If beverage is in your lane, in your wheelhouse, if you have a knack for it, congratulations. I'm going to stay in my lane. I'm going to keep making money the way I make it. And I hope you keep making money the way you make it. All right, let's take a look at the heat map. What's going on with the heat map, Daryl? Are we going to end February on a bad note? Well, look at that. Into it. It's trying to say no. We're not going away quietly. That's pretty good, Daryl.
Yep.
They could stick the landing.
Yep, that's very good news. I'm glad to see it.
Now, this is less than an hour into trading, right? So the horse is not in the barn yet. We got the horse on the ranch. We're walking toward the barn. For all I know, this thing goes super red because this market's been a little unpredictable. Let's take a peek here. So we got, is it Adobe's up? So we've got in software, Autodesk had a really good week. Did you notice that? And Autodesk, I don't think is going to be disrupted by AI because Autodesk is used by people that are designing products, and they really design a product in Autodesk, and they collaborate and they design the next, generation product and so forth. Intuit is higher. Uber is higher. So Autodesk is that green one. FICO's been really beat up. Adobe's down. Salesforce is down. Datadog is down. ServiceNow is down. I'm going to talk about the big ones here. Uber is up a little bit. Workday, man, Workday's been getting smashed. All right. Palantir's having a good day. And looks like Dell has just been, killing it today. 18% higher. Good for them. Netflix on a roll. This is like, they left divorce court and the judge sided on their side. All right, cool. We get all those billions. And Verizon's higher. This is a nice safety category here. So understood. Energy's higher. Consumer staples doing well. And looks like Walmart's going higher. All right. Pharma going higher. What's going on in pharma? Boy, that's a nice green day. And that's what I'll note there. Let's keep rolling here. So Mike wanted to look at Duolingo. Everybody, brace yourselves. Brace for impact. Boom. Not as bad as I thought. Okay. But these guys have just been under. Jeez, man, what? This situation's bad. So Duolingo, it's a mobile learning platform. And yeah, it's fun to use and so forth. But from what I've seen in AI, like their AI is like, did you see that scene with, I think it was Tom Cruise and Brad Pitt, and they were
I
fighting?
heard about it. Yeah, I heard about it.
I saw the video. And if you would have told me that was real, well, I think the scene was a little outrageous. And the I would say the physical fight that they had was kind of hard to believe. But the face and the features and the bodies and totally real. It's like, whoa. And I think Hollywood was like, oh my God, that's really good. And we're now like feeling really threatened. They should. Duolingo should as well. Everything Duolingo does could be replicated by AI. These guys are right in the path of disruption. And the market knows it. I don't think it's hard to figure that one out. So these guys, can they? I don't know. I hate talking like super bad about companies. It's just the situation. I can't see it going any place other than disrupted. Qualitatively, I just can't touch the stock. There's no, where do they have a network effect? Not really. They're an app. Users will go from one app to the next, like on a heartbeat, and I think they don't have like Facebook, where would you leave Facebook? Well, I got all my family members there. How am I going to know whose birthday it is? And like in our family, when it's somebody's birthday, right, we just go crazy, and there's like 50 messages of happy birthday, and it makes people feel good. I know when my birthday feels good, that there's all these messages. Well, how can you leave Facebook? You got that anchor to that app. Duolingo doesn't have that anchor. They're like, oh, AI's got an app, and it's a little nicer, and it's cheap, and it's free, and voila, you're done. So qualitatively, I can't enter a stock like this. But let me send it over to you and see if you have any comments on Duolingo.
And speaking about birthdays, I told my wife yesterday I officially feel old, and she said, why? Because I spent some time on the Medicare.gov site applying for Medicare. So you're old when you do your application for Medicare. That birthday's coming up really quickly. Okay, so let's see here. Yeah, this one is pretty pitiful, and we've warned about it for a while on the charts. The 200 days declining, 50 days declining, 21 days declining. And they announced earnings, I guess, yesterday, and took a big fall. I saw some options owners that were talking yesterday. You always got to be careful going into earnings when you're holding options. So take that as just a cautionary. If you don't know about options fully, or if you're new to them, they can really hurt you on days like today in Duolingo. So just keep that in mind, because the implied volatility, the way calculations are made for options pricing, implied volatility is one of the inputs to that calculation for how much an option is going to cost. As soon as the uncertainty is known. So once earnings are announced, the uncertainty goes away. The volatility comes down and the price of the options collapse. So you really need to be careful holding it on the day of earnings, unless you're really confident one way or the other. So I've learned the hard way, and I'm passing that knowledge along to others. So we've had 3 auto support resistance lines in place here. They've broken through 2 of them. Seem to have found support right here, but now they're breaking down below that. So we'll see if they continue trading lower. They had high volume yesterday on price action that there was a little bit of a bid spread there from 112 to 117. So this isn't quite as bad as Intuit and CRM that we looked at earlier, but we had about 3x volume, and the price just kind of remained steady there between 112 and 117. So I think some people were probably taking opportunity to get rid of some shares yesterday before the close and the earnings announcement. Whether they knew the whisper numbers, you never know, but somebody knows that. And then they really took the hit today. They are trying to make a little bit of recovery. The RSI stalled at 40 and is now back down to oversold. We did have a buy signal a couple days ago, but that's in bearish territory. And we have had a little bit of accumulation, but the money flow is neutral and has been negative, had been bearish since the 22nd of December. So this was a hope and a prayer if you continued holding it.
Rough. All right, so here's the valuation on Duolingo, and I'm going to give you a personal story that relates to AI, that relates to this channel. All right, so Duolingo's overpriced, and it's really going to zero. Qualitatively, that's where I get to. Now, how is AI changing things for this investor? As you guys know, I've had this channel for a couple years. I predominantly use Google Sheets. So when we look at Google Sheets, the finance calculations that I use have been around for 100 years. Net present value of the future cash flows is what I'm calculating here. Net present value. I was taught this when I was in college. Okay. And that's what I'm using there. And I'm using cash, debt, and then we're trying to get to a per share value and so forth. So this is done on a spreadsheet layout, and I use my logic and my experience for that. I put a forecast together, I put growth rates and so forth, and I get to a value per share and then a current price on the stock. So over the course of 2 days, I created an app. 2 days. Probably 12 hours of effort. This is an app that I had previously tried to work with a team of people to build, and I was willing to pay for it. And it was a failure. We didn't get there. Then I worked with a developer, didn't get there. And it was mainly because they got busy. But in 2 days, I built this app. And if I could build this app, and I'm educated up to a master's in business, so the finance and the accounting and the business, and I do know software at a high level. I have that skill set, but I was able to build this app. How does this relate to Duolingo, Intuit, CRM, and so forth? Well, Duolingo doesn't have a strong network power. Okay. Obviously, they don't have a moat when it comes to their technology. Others can replicate it quite easily, and they don't have a strong customer loyalty to Duolingo. But when you deal with a CRM, it's different. Enterprise is different. If you have a business that has literally 50,000 people at their company on Salesforce, it is really hard to move, really hard. So they have that network power. They can keep customers and they can use this AI technology like I did to make their costs lower, to roll out features much faster, and it gives them a big advantage. Same thing with other software companies that have that ability to keep their customers. Intuit, the small business person, right? Let's say you're a construction company owner, you use Intuit and you do your billing out of it, and you're working 60 hours a week, and you don't have time to change over from Intuit to a new product. You got QuickBooks, it does the billing. Your cash flow is dependent on QuickBooks. You're going to keep using QuickBooks. Your taxes, your taxes on TurboTax, you could do them for free if you have a simple form, but most of the time you're going to pay $150. Maybe you pay $250. I have to pay more because I have real estate assets and stuff, and I have to do this complicated return. But if somebody offered me free, even free, hey, I'll do your taxes for free on this software, I'd probably be like, no, man, I just need to get through my taxes and be done. It's a very difficult, painful, risky switchover cost. Duolingo doesn't have that. So when we look at software stocks, we have to qualitatively determine, is there expensive, dangerous, painful switchover cost? Do they have network power? Because if they don't have any of that, then they're probably going to be disrupted. They have to have something to fend off this new technology and actually grab this technology and make their businesses stronger, better, faster. Okay. All right. Okay. So Intuit, going higher. Man, Daryl, this market last 2 weeks has shown me a couple. It's like I'm digging in dirt, right? And I'm not a miner. You're going to tell in 2 minutes. And then you see a glimmer of ore down there. Oh, wow. Hey, we may have hit gold, because I've been digging over the last 2-3 months thinking, man, this market's really hard to figure out. But Intuit is showing signs of life. Would you mind is there any way you can look at the data again? I'm going to look at my valuation again. And I'd be curious to see if you're seeing anything in the charts that tells you something interesting. For the last 5 days, these guys are up 6.5%. Look at that. Last 5 days. And the valuation on them, I showed it a little earlier. And they're highly discounted. And again, I look at them qualitatively, and they're going to keep their customer base. It's a strong business. It's going to be a strong business going forward. And I'm optimistic that these guys in 2-3 years, it's going to be worth a lot more because they keep growing. But let me kick it over to you and see if you can look at the charts, maybe the most recent daily data, and what's it telling you?
Well, this is looking better than the CRM chart that we looked at. My process, and I follow a process very rigorously, so I don't get too terribly excited when I see these. So yesterday I was thinking it was going to go down. I'm not fully convinced that this is real, because I think a lot of institutional investors sold out yesterday. The price is going up today, so that's a really hopeful sign. But my process would say, don't even think about entering this until you get above a 21-day sustainably. So I'd rather pay $4.33 for a stock than pay $3.92 or whatever it's trading at today, $4.06. I'd rather pay a higher price because my risk is lower if it gets above this particular moving average. So that's my process. I follow it rigorously, and I don't mind losing out a little bit on price because I feel comfortable with my process.
In software, my position right now, which relates to your comment right now, is I'm not buying any more shares. I'm not selling any shares. But like you just said, the upside in software, especially Intuit, there's so much upside that if I show up a little late, I don't care. I'll make money over the long haul. But what I do care is, what if this thing starts going further lower, and maybe the story gets even worse for Intuit? Then I'm kind of putting capital out there. If best case, my capital's idle, but worst case is the capital that I deployed today even goes down in value. So I'd rather just be a late on Intuit to buy new shares. I'm not selling into my current shares, but it is setting up that, hey, I could be like I showed the Netflix charts earlier. This could be the next Netflix, where 2 years, 3 years down the road, hindsight's 2020. You're like, wow, man, anybody who bought into it back in early 2026 is up 100, 200%. Back to you, Daryl.
Yeah, so we still have a 50-day that's declining, a 200-day that's declining. So overall, the trend is down. But this is today. Looking at one day, this is good price action. It is staying above an upward sloping 5, but I've explained my process. I won't even look at this until it's at least above the 21-day. It has to be above the 40 before I'll start getting interested. And the PPO is very, very negative. It is very bearish at the moment. We do have a buy signal, but we are way below 10% below the midline. Anything above the midline is bullish. So it's got a little bit of work to do to convince me.
All right. Well, hopefully it gets to work, convinces Daryl and a bunch of other investors, and the stock continues to go higher. In the meantime, let's turn our attention over to Freeport-McMoRan, which is a mining company in North, South America, Indonesia. They explore for copper, gold, silver, and other metals. So these guys are doing well. 6 months. Look at the 1 year, 5 year. 5 year looks less impressive than I would have thought. But this year, I mean, you did well with Freeport-McMoRan. And their revenue hasn't been, growing. The last quarter, the revenue actually was a little lower. That's interesting. I think the whole space is getting a lot of new investment because the price of silver, price of gold have really gone up. So those that are mining for those minerals, their stocks are going up. Forward P of 22.88. This is not in my immediate circle of competence. Now, do I know what copper is? Absolutely. Do I know everything there is to know about copper? No. I don't. In silver, I don't know much about silver, and I don't know much about gold. So this is outside my circle of competence. And I do invest in one materials company, not this one, another one. And that one, I do have kind of a story behind that one that I like. This one here is up nicely. When we look at their forecast, analysts do think this one's priced too high. And the forecast, we're in this year, they're supposed to do well this year, up 12.5%. So that looks good. And their profitability is going to expand. I'm curious to see what are their gross margins and so forth. So here's margins. Gross margin is 37%. Their profit margin, 8.5%. That's decent, but it's not like, wow, that's great. Free cash flow margin, 4.3. Not good. So these fundamentals are not overly attractive to me. Attractive would be 85%, 35%, 35%. That would be kind of an A grade on desirability. This is more like, this would be like C's. You passed, you get to go to the next grade, but you are not ahead of the class, nowhere near it. I'll show my valuation after you look at the charts. Over to you, sir.
Yeah, the chart actually looks pretty strong at the moment. I didn't go back in time, but it's trading above all upward sloping averages, and they're all in the correct order. It's tested the 21-day once on like the third week of February. Other than that, it hasn't touched the 21-day. So this is why that 21-day is important in my process. Once it gets above that 21-day, if this is a stock I was looking at, that's where I would be thinking about buying. So this one looks good at the moment. It has run up pretty high. We have an RSI that has not been in overbought territory since the 29th of January. They are above 60. We're on a buy signal in bullish territory. So see, this PPO is above 0. We were just looking into it, and it's a minus. It's 10% below the midpoint. This one is 5% above the midpoint. So it's pretty bullish and has been bullish since the 25th of November. So very strong. And look at the accumulation, monster accumulation right now. So we had 4 or 5 signals that were saying buy this.
Interesting. So my valuation's like way away from a buy stock. So the stock's really taken off, right? Now, based on the value of free cash flows, growing those cash flows by 10%, discount rate of 9%. Why do I use 9% on this stock versus 7.5% when I used Intuit? Intuit has a relatively low risk business, right? They're headquartered in the Silicon Valley somewhere, I think Mountain View or something. And they distribute online. And can their supply chain be disrupted? Not really. They don't have a supply chain. Okay. So that risk is off the table. Now these guys are mining, right? So what if they have a cave in on one of their mines? 10 people die. Oh, that'd be horrible. Not only would you have that bad story, but maybe that mine ceases to operate for the next 6 months until they make it safe. So there's a lot of risk there. You have to buy a lot of machinery, just risk after risk after risk. So that's a higher discount rate. Terminal value is going to be a little lower because they're not growing all that fast and it's very cyclical. So when I run the valuation, I just can't get there. And even when the stock was even lower, it was a hard stock for me to buy. And silver and gold are going up. So the stock price is going up. So if silver and gold continue to go higher, this stock price is going to continue to higher. If you do have a lower silver and gold price, copper, this is gonna fail. It's gonna come down pretty hard. So you can't really. This one's a hard one for me to like put a lot of money into. I'd never put money into it, but it would be really hard because I can't really see clearly the next 5 years. I don't know where silver is going to be in 5 years. I have no idea. So that is FCX. All right. I think we covered a lot of ground. We're going to end with GDRX. I've covered at least one stock per member that's put up their list. Let me take a peek here. Intuit's still a little green. Computer hardware still good. Pharma still good. Consumer staples. So it's a risk off day. What's going on and why are financials down? Do you have any idea? Why are
That's
big
a
banks
good
down?
question. I've heard conflicting stories, so I don't really know for sure.
Man, I can't put my finger on that. All right, let's talk about Good RX. So Good RX is a little bit like Hims. It's down today. They announced 2 days ago. And over the 1 year, man, that is really, really rough. They came out, they IPO'd back here. And we still had the reason they IPO'd so expensively is during COVID, the healthcare industry became incredibly important because we wanted to get through that darn pandemic. Over 1 million people died in the United States due to COVID. That's a lot of people dying. It's really sad. So we wanted to get that darn pandemic, out of our world. And healthcare became really, really important. And so these healthcare stocks came in pretty expensive. And now it's been a pretty rough ride for anybody who bought when this thing IPO'd. Over the 1 year, it hasn't really changed. It's been a really, really rough ride. And Ben 10's got a comment on financials. Something happened in London with credit. Oh. The plot thickens. Our guy in London is reporting. Back to Good RX. So let's take a look at their growth quarterly. So they're contracting. So that's bad news because they're not that big. Okay. We're dealing with a company that's less than $1 billion in revenue, 796 million, and they're not growing. Well, when you're that little, if you're not growing, that's a big problem because, I don't even think Amazon knows who these guys are. But this is like, I don't even know. I think Amazon does this amount of revenue. Yeah, they do. Amazon does $2 billion of revenue a day. These guys do less over the course of a year. So I don't even think Amazon cares about these guys, but this is somewhat in Amazon's business because these guys are doing healthcare. They compare prices on prescription drugs and so forth. Yeah. And, on my healthcare, I don't shop around. I go to the doctor, says, go get this one thing, go get my prescription filled, take it as prescribed, and I move on. I went to the dentist Monday, went in, boom, done, next. Went to the optometrist, boom, done, next. I don't even go from my optometrist to Costco or elsewhere to get less expensive like glasses and stuff. I just like to get through my healthcare, process. I want to stay in good health. So these websites to me are like, my life's already complicated enough. Like I don't need to go shop around to save 10% here or there. And it might be different for other people, but that's just one consumer speaking based on preferences. And these guys here, the revenues are contracting. So the stock's under a lot of pressure. Look at this discount. Wow. 146%. And it's expected that they're going to grow this year by 4%, 7, 10, and then 5. If they start growing fast, this thing's going to reward investors that believed in them. High risk, high reward. If they start growing, look out. This stock's really going to move high. This could be a 2-bagger, 3-bagger, 4-bagger over the next year, 2 years. But they have to grow. Okay. We can't reward them. It's not like, the Olympics are coming. Is it this summer? I think so. And, he's the number one, marathoner. So let's just give him the gold medal now. Nope. He's got to run the marathon and prove that he is the number one marathoner. and then we give them the gold medal. So they got to run their race, and they got to come through with nice growth, and then this stock could work. This is a good watch stock because it's priced so low, and if it really comes through and they have this forecast, if they hit this forecast, I think this stock's going to really go higher and reward investors. What do you think, Daryl?
That's an ugly chart. And they're trading below $2 a share right now. They've been in a downcline or a downtrend. I'd have to go back in time because I can see the 200-day over here has just continually been going down. The 50 days declining, 21 days declining. Yeah, so I look at the accumulation over the past year. It's just been a bloodbath. And I see, few weeks where people move into the stock, but then it spends months with people getting out of the stock. So I don't know. It's a pretty ugly chart.
And beauty is in the eye of the beholder, sir. But I do agree that the chart doesn't look good. GoodRx, highly discounted. If they can grow, this could be a real good reward to investors. But if it doesn't grow, it's irrelevant. It's going to be unnoticed. It's going to be like, GoodRx is just going to basically fade into nothing land. So we'll see where it goes. They need to put up some growth numbers. All right. So we made it through a big list, Daryl. Thanks so much. Nice work today.
I saw a couple questions that I'd like to address, if you don't mind, real quickly.
All right. Which one do you want to go to first?
I think Benton mentioned monthly dividend payers.
Uh-huh.
So I have a small list here. These are the ones that I like. So Agree Realty has done very well. Keep in mind that that's trading at an all-time high right now, so it may not be the best time to get in. But I have a average cost of $64, and they're trading at 81 right now at an all-time high. This is a closed-end fund. It's related to science and technology. This one is actually selling off a bit today and is not at a bad buy price. Since it's a closed-end fund, you got to keep a look at its net asset value and try to buy it underneath the net asset value. I also invest in JEPQ, EPQ. I have a small investment there. Realty Income is another. That is my largest holding. But once again, it's trading at all-time highs right now. So be careful getting into it at the prices. I have an average cost of 59, and it's trading at 68 right now. I suspect it's going to run up to about $80 a share. So you probably got about $13 left, but just be careful. Then these are treasuries. This is a high yield bond fund that pays monthly. It's also trading near all-time highs right now. When you buy it is very important. I wouldn't necessarily recommend this one. This is can't remember what they call that. They sell covered calls on it. I've done very well with it, but when you buy it is important. And then this one I also recommend, but keep in mind it's trading at a high valuation right now. Keep an eye on the NAV. If this is a closed-end fund, so keep an eye on the NAV and make sure you buy below NAV. But this one has performed very well. It pays monthly. I have an average cost of around 33, and it's trading at 41 right now. So it depends on when you buy it. I like BST really well. It's performed very well and pays 25 cents a month per share. And at the end of last month, they paid out a special dividend, which they do every few years. So it's a nice monthly payer.
Thank you, sir. And
And there
okay.
was one other question from Mike. If you don't mind, I wouldn't mind taking a look at. He asked when to know when to sell. So let's look at CRX, because he specifically mentioned energy companies because they're trading at all-time highs right now. I also have a process for this. So you can see my orange line here, and I have two red lines. I use chandelier exits to identify based on average true range over the last 22 days. So it takes volatility in mind. The pricing changes over time for 22 days. It gives me a price where I should consider selling. So right now, my 3 times average true range is sitting at 178.03, and you can see we're trading at 184. So every day when I review my charts, I look at the chandelier exit, and this line is a high water mark. So once the chandelier exit keeps moving higher and then it stops and starts declining, my orange line does not change. Once it gets to that orange line, that's my sell point. And when I say sell, I don't mean everything. I may sell 10% of it, because often it'll just recover and go right back up. But if I see a sustained drop and it gets to 5 times that average true range, then I'll sell 50% of my holding. And if it continues to go down and hit 7 times the average true range, then I sell all of it and wait for a recovery in the price. So I know based on my process exactly where I'm going to sell every single day, because I review it every single morning and make a decision where I'm going to sell or trim. So hopefully that answered those 2 questions.
So thanks everybody for tuning in. And we've had a lot of chat messages. I wanted to make sure I covered at least one stock per member. And it looks like Sam wanted to look at TMDX, which we're going to do. And then Peyton wanted to look at Figure. So we're going to look at those, and then we're going to close out the stream. So starting with Transmedics, these guys are doing quite well. Over the 1 year, it's up 90%, but it's been consolidating for, I guess, about 8 months, not really deciding to go higher. And the company was growing quite well. I mean, look at this growth. There's really, really nice growth, but the growth is beginning to flatten out, 32%. And when we look at the forecast, that's where the flattening really is clear. And again, when you go from like these really fast growth rates down to 17, 13, 17, these are good growth rates, but they're not phenomenal like the ones before. And the PE ratio is still elevated. Okay. So that's a pretty elevated PE ratio. They are nice and profitable and have good free cash flow. But I would be concerned with, man, these numbers are getting pretty low on the growth rate. And this is a small company. So if this ends up being a slow grower, the stock's probably going to fade, probably give up some of its gains, because it's done really well over the 5-year, up almost 300%. So I'd be concerned about that. Let me kick it over to Daryl and see if he can tell us anything he's seen in the charts, and I'll come back to the valuation.
Okay, I was just responding in the chat there. So medical companies I find to be somewhat difficult. I've owned several of them and finally decided to stop doing that. Not that I'm discouraging anyone else. I've just found them a little bit difficult. So this one has been trading sideways. We have an upward sloping 200. That's really good news. We have a whole lot of congestion right here looking at the 1-year chart. So I'm going to move in just a bit. they've been oscillating around the 50-day, so can't decide whether it wants to move higher or lower. So it's just oscillating around the 50-day, which is pretty much trending sideways. The 21-day is doing the very same thing, at least over the last week or so. We did get a little bit of a bump at the early in January and settled back down and just seems to be holding here. So let's go look at the RSI. They are moving closer to 60, so they have moved above the 50 line. Anything above 50 is bullish. Anything below 50 is bearish. I'm seeing the PPO right at the midline, so it can't decide using the PPO, which is the percentage price oscillator. It's very similar to MCAD. I just prefer PPO because it expresses the value in percentages, so I can compare it from one stock to another, like I did with Intuit and one other one earlier, where I said it was down 10% compared to the other one being up 5%. With MCAD, those are expressed, MACD, those are expressed in just absolute values. So it's really hard to compare between one stock and another. With the PPO, I can easily compare because it's expressed in percentages. I see they did get a little bit of a bump money flow wise, but it's currently neutral. I see mostly distribution over the past year, a little bit of accumulation, a sell off, and then a bit of accumulation yesterday. So I don't know what it's going to do. It's definitely trading sideways and really has since June of last year in the overall scheme of things. I just find these medical companies, medical supply companies especially, a little difficult.
Got it. And when I look at the valuation on Transmedics, that lowering of growth rates really brings down the value for me. And the stock's price 21% too high. I think the stock was a growth stock, and now it's a slow growth stock because it's a small company and it is a small cap. So I'd actually probably increase my risk factor, my discount rate, probably make it less desirable as well because it's a small cap. Things can happen in small caps that surprise us. So that's where I'm at with Transmedics. Thanks for asking, Sam. Sorry to make you wait a little bit. And thanks for putting your comment in the chat. We've got a lot of chat messages. If I missed your chat message, I apologize. And the last one here is Figure. So Figure is down a lot today. These guys are a new crypto company, and they want to do lending on the blockchain. Got it. And this space is kind of hard to figure out. I'm a Coinbase stockholder, and I think Coinbase is doing some things that are setting up the rails on, Web 2 crypto rails, and they're doing it successfully. So a lot of ETFs that you buy, like Bitcoin and stuff, it's actually on the Coinbase rails. So I really like that whole story. Figure is a new issuance. It hasn't been around a long time. It's been around less than a year. It IPO'd September 11th, 2025. And from its IPO, I mean, it's up a little bit. It went up a lot in late December, early January, but it's really faded. Since then, it's gone from $73, $74 a share down to $27. Whew. That has not been fun for investors. And this one here is a hard one. They are growing, very good, but what's their business about? How successful are they going to be? They're little right now. They have 100% gross margin because they're pretty much just providing the platform, kind of like Visa. Visa has very high margins like this. In the forecast, we've got 9 analysts covering them. The growth is going to be good this year, 37%, 21. This is a good one to keep an eye on. I don't like investing in IPO stocks because you got to get some good like financials out there, get to know the business. And this one here is in a new industry, new IPO. There's a lot of new to it, a lot of undetermined territory here. So I'm not ready to jump in. I did buy eToro recently, but eToro resembles Robinhood. It resembles Futu, which both have been excellent investments. And I'm like, hey, I understand the eToro business. I understand how they're trying to make money. I understand the regions they're trying to go after. So that one is less than a year old from its IPO, but I think I'm getting a good price on it. And I've made a small investment in eToro. So let me kick it over to you, sir, and then we'll finish the show on Figure.
Yeah, I'm a big fan of what Figure is doing. I put out at least one video, and I have another one that I plan to do because I'm still a big believer in what they're doing. I think once we start seeing um, the housing market improve, that they're going to be kind of a go-to lender. One of the things they're really specializing in right now is HELOCs. So you can get a home equity loan on your house. Normally, if you go to a bank, that process takes about 45 days. Figure can do it in 5 days or
Wow, that's
less.
good.
Yep. And they also are moving into the market and exchange place. So they just had their entire secondary share offering on the blockchain, where normally it takes 2 days to settle those trades. And if you're talking, this is a small company, but if you're talking trillions of dollars that's being traded every day and it takes 2 days to actually settle trades, you have money kind of locked up for a while.
Mm-hmm.
They're trying to solve that using the blockchain, but they just issued their secondary offering on the blockchain and it settled in 0 days. It was almost an immediate settling of that secondary offering. So I think what Figure is doing is incredible. And I'm down big in it right now, just so you know. But I am not giving up on this company. So the founder was the founder of SoFi. The one thing they're doing different than SoFi, SoFi actually holds their loans on their books. Figure does not. Figure moves any of the loans that they're making into um, basically a pool that investors can choose to invest in. So it's investors that are holding those loans at a pretty high interest rate. So they're getting good benefits from pushing those loans off to investors. So I like what Figure's doing. They have a lot of experience doing it. The guy, one of the guys was the co-founder of SoFi, and the other, I can't remember exactly what he was involved in, but he's got a lot of experience with this. They are making very good progress on getting their proof of concepts out the door. I think once this thing takes off, I think it's going to be a very good performer. But I'm in the hole on it right now, just so you know. I am invested in this one.
And when I do a valuation on Figure, just using some, I'm going to call them conservative numbers, but realistic, it just shows that the price is a little too high. And, time will tell if these guys continue to make themselves bigger, more valuable. I agree that we can find ourselves where, instead of having these big like banks that are very inefficient, they have a lot of people working there. And I'm not against people having jobs, but it makes lending money really expensive when you have, 10, 20 people involved. And if you had a platform where you're like, hey, we are going to open this up, and I think I used the wrong symbol here. What is the symbol? FIGR?
Yep.
Yeah, it's a similar story. So I kept the same fundamentals here. Um, I think the world is going to be more like what the world that Figure's trying to build in the future. Totally get that. Um, I just don't want to invest too early. Coinbase had a real business, has a real business now, and they are not necessarily trying to compete with Figure, but they are trying to put down rails similar to what they're doing. And we'll see how it goes.
Figure does have 250 high profile partners that are moving their loans over to Figure. So it's not
Cool.
an unsustained business yet. I
That
mean,
might
they are
be
making progress.
that might be like an excellent idea where, if you have all these like old school companies that are doing it very inefficiently, and Figures like, hey, get on our rails and you're going to cut a lot of cost and you're going to expedite your loans. That would make total sense. And now you have these brands that people are very comfortable with. Hey, I'm going to go get my loan from Bank of America. They don't know if they're on the Figure rails, but boom, next thing you know, everybody wins. Bank of America wins, Figure wins, the customer wins. And Mike was asking, is there a good buy-in price for Figure?
I like what the company's doing. The price has been all over the place, and they've only been around since September. So the price is below 30 right now. They just had their secondary offering at 32. That's what caused this volatility right here. So when they offered it at 32, it drove the price down for a few days. And once those however many millions of shares that they issued on their secondary offering got consumed by the market, then things will start settling back out. So you're going to have to pick the price, but I like the slow price better than this price up here. And it's at a low that's below their IPO offer, or above their IPO offer, but below the close of the very first day. So you have to believe in the company. I mean, if you don't believe in the company, then I would not invest in this one. I happen to love what they're doing.
All right. So looking one last time at the heat map, it does seem a little better than the last time we looked at it. Semiconductors not selling off as harshly. Got a couple more green spots. But for the most part, we are going to go lower. And unless something changes, we are going to close out with a lower trading day. But I think that the market's showing me that it's beginning to be rational in some spaces. I mean, the buying of some software stocks is rational. The selling of semiconductor is both rational and irrational at the same time. I thought semiconductor was expensive going into NVIDIA earnings. And if NVIDIA earnings can't make the stock go up, I'm like, whoa, I guess a lot of investors felt the same way, that, hey, semiconductor is expensive and investors are taking money off the table. So that's encouraging. And, I don't want to talk too much about healthcare, but healthcare has been showing some glimmers of hope. And so we're going to march into the new month, and there is a pun there, and see how we make March work.
I see the VIX is climbing back above 20 today after being down to below 18 yesterday.
Looking at the contest, looks like Genetic Smite has got a pretty good lead here. He's lapped the field a few times. And the year is young, but it's a pretty good lead. Good job, Genetic Smite.
Yeah, very good job.
Jeez. That's just in less than 2 months, because after today it'll be 2 months, but that's a heck of a stock. All right, sir. Well, thanks so much for co-hosting with me. Thanks everyone for tuning in. And we had a big audience today. Appreciate it. We had a lot of chat messages. Really appreciate that. Hope you guys have a really nice weekend. Let's reload and figure out how we can make March work for all investors that tune in. Tune in next week. We'll be streaming again. Thanks again, Daryl. We'll see you guys.
Thank you, Victor. Thanks, everyone. Thanks